Hi, I'm Owen, the host of the Australian Finance Podcast. This podcast is proudly sponsored by BetaShares, one of the leading providers of ETFs here in Australia. Serving thousands of financial advisors and over 1 million investors, BetaShares manages tens of billions of dollars on behalf of investors right across the country. I'm proud to partner with BetaShares on the Australian Finance Podcast, Australia's premier financial podcast, because there is great alignment in the long-term philosophy shared by both businesses. I hope you enjoyed this episode of the Australian Finance Podcast. Gemma Mitchell, welcome to this episode of the Australian Finance Podcast.
I'm excited to be here. Thank you for having me. You're ringing from the
I'm just reporting straight from the field. As you can see, if you're watching me, I am recording from the dog on the tucker box. Now you had to Google what this is. So dog on a tucker box. What is this?
It is literally a statue of a dog on a tucker box. And where you couldn't believe that Monique, our producer, and me did not know what it was. And you just kept repeating, dog on a tucker box, dog on a tucker box. I'm that's not healthy.
So in order of most important tourist landmarks in the whole of Australia, it goes dog on a tucker box, Great Barrier Reef, Sydney Opera House, 12 Apostles, Margaret River.
What's the 12 Apostles?
That's
I'm joking. I'm joking.
Oh, get out of it. Get out, you Fraser Island people, honestly. So we are talking about many different things today. We've got questions on the First Home Super Saver Scheme. Someone's paying a lot in tax, like $100,000 in tax. Yikes. Someone is asking, at 59, can they do some early retirement maneuvers to compound their super faster? And the final question we'll answer is, where can I buy some gold? Like, how do I actually pull that off? But as we normally do, we start with what you've been working on this week. So you are coming to us from a different location as well. But what have you been working on?
Busy week this week with Rask advice, which I think we say every week because this is a huge project to get off the ground. But I've had lots of client calls. So I think it's Thursday. I think in the last 3 days, Monday, Tuesday, Wednesday, I've done probably 20 15-minute calls with clients looking to find out about Rask advice, which is pretty cool. Yeah,
that's huge.
Lots and lots of interesting, people. It's been really, really great.
That's huge. I did actually take a little squiz at your calendar, and I did notice there were these like thin little lines when I looked at it, and I was like, "Yeesh, that's a lot of meetings." But yeah, that's super cool. And you're in busy today. Did you say State of Origin last night?
It was State of Origin last night, and I'm officially a Queenslander because I've lived here for 15 years, and New South Wales won, but they just won the first game, so.
It's best out of 3, right?
2 more to go, yep.
Yeah, cool. I have been in Queensland, like in and around Gold Coast and Brizzy during the State of Origin matches. Like, I'm a Victorian, obviously, and I know you guys absolutely froth it up there. So all the best to the Maroons.
A big deal.
That's what I'll say. We do have an update, a very important update for everyone that listens to the Australian Finance Podcast every week in just a moment, to do with ice cream, which no doubt is absolutely scintillating stuff. We have been very, very busy with Rask Advice to the extent that we have actually been hiring quite a few people. So if you are a talented advisor, you're a CSM, like you're in customer service, or you're in that world of finance, you're a paraplanner, a modeler, you're a tax advisor, I would love to hear from you. Just seriously reach out if you want to be an associate. Reach out. You can find us on the website. We do get a lot of people reach out when we do ask. If we don't get back to you, we do apologize. But just if you're looking to do that, we're looking for people with a little bit of experience to come into associate roles, or the customer service roles, and obviously tax advisors and financial advisors. So other than being a dog on a tucker box, which is absolutely groundbreaking news, we do have an update on Viennetta ice cream. Can you please fill us in?
Viennetta.
Yes. It is.
Viennetta. So that was so long ago. It's been a while since we've actually done one of these. So I did find a Viennetta. My local Coles didn't have it, but Woolies did. And they're now $8. And it was pretty good. It wasn't as good as I remember it tasting, and it was smaller, but maybe that's just because I'm
shrinkflation.
It's 20 years ago, so I'm bigger. But yeah, no, it was very good. And they still sell them.
Yes. Okay. So if you're catching up, we did an episode a few weeks ago on the signs of wealth, and I said that people that have a holiday house nowadays are just like loaded. And you said it was people that have this Viennetta ice cream when you were younger. And
Yeah.
I do remember. It's a very peculiar thing to remember, but amen to that. I remember, I'm old enough to remember when cutlets, like lamb cutlets, were the cheapest form of basically meat. So we would eat lamb cutlets when we were younger because it was the cheaper option. And now you look at it and it's like crazy how expensive that kind of thing is. I did actually miss last weekend's show, but I did tune in and heard you and Pete talk about a few different things. I've got to admit, I could listen to Pete Wargent, who co-hosts our Australian Property Podcast. I could listen to Pete talk literally all day, and I think I do. Like I tune in regularly, and that was such a cracking episode. So if people want to go back to last Friday's episode, go and check that out. All right, so we do have a lot of questions that have been sent in this week, but there are 4 that you've pulled out, which are fantastic. Before we get to the question answers, it's important to remember that anything that we do talk about in the show is strictly general in nature. We don't know your needs, goals, or financial objectives. So be sure to reach out to a financial advisor who can help you make a decision if the information you're about to hear is right for you. We do like for you to give us a funny name on the way in, just to kind of keep it fun, keep it happy, keep it healthy. You can write in your question by going to your podcast player or the YouTube description if you're watching and click ask a question, just like the Australian Finance Podcast. We do love questions, so please keep them coming in, and we love a bit of banter in the questions as well. The first question is one that's very topical right now, given it's towards the end of the financial year, being June 30th. Sheila Frugalism says, with the first home super saver scheme versus not having your home deposit invested, everyone seems to say don't have your first home deposit invested if you intend to purchase a home within the next few years, but also in the same breath encouraging the first home super saver scheme, which is invested through superannuation. I'm really not sure what to think. Now, before you get to the answer on this one, or you can weigh in, Jem, we are doing a first home super saver webinar coming up. It will also feature here on the Australian Finance Podcast. So that is coming up in the next week. Stay tuned on the Rask YouTube channel if you want to come along and ask any questions you have about the first home super saver scheme using super for your deposit. A key cutoff point for that is June 30th this year. So please get in contact by going to the webinar that will be available on the Rask YouTube channel this week. Great for first home buyers. So Jem, the question is, well, everyone tells me not to invest, but then people are saying, use this thing through super to buy my first house. What do you think about that?
That is a very valid question, and I can see absolutely why that would be confusing, because our superannuation, for the most part, for most of us, is invested long term. It's usually in a default investment, usually has a lot of high risk, depending on your age. And for first home buyers, they generally have like a lot of growth assets in there. So yes, I totally understand that. But the interesting thing about the first home super saver scheme is that what you put into it, up to $15,000 a year to the maximum of $50,000, while that is invested however the money is invested within your super fund, when you go to pull that out, it doesn't actually look at the earnings, how your super has performed at all. So when you pull the money out, it's what was allocated to that scheme, and then an interest rate is applied to it that currently sits around 6 to 7%. And this is like a deemed interest rate that's set by the ATO. So if your fund overperforms that money stays in your fund. So say the ATO deems it at 6%, but it actually returned 12, that extra 6% is staying in your fund. You're not getting it. On the flip side, if that money went backwards, or you only got a 2% return or a -2, you are still getting your allocation back plus the 6 to 7%, whatever the ATO deemed it at. So the investment returnings affect your super, but they don't actually affect what you pull out towards this scheme. So that's why it doesn't actually work the same as if you were going to invest in shares in your name, because then you're just relying on however they perform. But the first home super saver scheme has a deemed interest rate.
So this is a really good scheme, and it's probably had a few small but important changes over the last few years to make it easier for people to understand and just to also put in practice. So it's more accepted now, whereas when it started, it was a bit like, oh, can I do it? You can also use it for more of your deposit now. And it's good news for singles and for couples because you can use it as a couple as well. So if you haven't owned a house before in Australia, you're looking to buy, you want to save your deposit faster, there's some great resources out there, including the government website, ATO, and also the Perla website, who's a sponsor of the show. They've done a lot of work on this. So go and check out those resources, or just come along to the webinar this week. Gemma and I will be able to answer your questions. I just want to hammer home that we do say when you're saving for a deposit or you've got a big expense coming up, it's best not to invest that because the stocks might fall or the ETFs might fall. Same with crypto, whatever. The key thing there is that obviously with the Super Saver scheme, you're basically getting whatever the ATO says you're getting. So it's kind of more like a bank interest rate than it is more like an investment account, if that makes sense. So definitely a good one. Elbow coffin feeder. So this is a very, very, very interesting name and quite hilarious for those of you that are up to date with your politics and your tax proposals. Elbow coffin feeder says, help, I pay too much tax from my salary income. It's over $100,000 in the tax bill. Jem, what do you think about this?
That is a big one. So I was trying to work out roughly what that would be in a salary. I think it's about 280,000 that they're probably on, which is, well above average. So it's a nice income.
Yes.
But that's a huge amount of tax, right? I can understand that hurts seeing that. And I think it's really important to see tax as an expense. So it is actually a bill, right? So people think of their expenses as things like, their phone, their electricity, all this kind of stuff. But the largest expense that most of us have this is a tax that we pay. So it is so important to be aware of what it is and be actively doing things to be tax effective. Okay?
Yeah, definitely.
Paying tax is a good thing. It means that we've earned money. We have a progressive tax system in Australia, but yeah, that's a big hit. So I can understand that they'll want to be as tax effective as possible. And potentially there's lots of different strategies they could be doing, like contributing to super. For one, they're probably getting pretty close though to their annual cap.
They are
the concessional cap.
29,600. Yeah.
Yeah, they were getting very close to it, but maybe they haven't always been on this income and maybe their super balance isn't at 500,000. So they might have some carry forwards they could use for a little while. So there's a few different things you could do with super contributions potentially, and you could talk to your super fund, jump on your MyGov and have a look if there's any unused concessional contribution. You could talk to an accountant or you could get financial advice for that. And then I guess I'd be talking to an accountant about, for my job and how I earn this money, what other deductions and things am I eligible to claim and offset this salary?
Yeah.
What else what do you think?
Well, there's a lot of things here without knowing what occupation they're in. So one of the things that we don't talk about a lot here on the Australian Finance Podcast, I mean, you guys did one on the last weekend because of, you talked about family trusts. So
Yes.
That was an introduction to what we call structuring. So for folks that aren't aware or haven't heard the episode, an individual pays tax like a person, but companies pay tax as well. And you can have different structures in Australia. Those are the two most common, companies and individuals. And obviously you got kids and stuff like that. Then you got super, which is a massive asset for most Australians. Then you have smaller things like investment bonds and even things like trusts and partnerships, legal partnerships, not in a relationship sense, but in a business sense. And so there's different ways to manage those. And importantly, I think with this person is one is if your income is secure and you're going to keep earning this or more, absolutely, as Jem said, deductions, look at super, look at that, is anything else that you earn on top of your job is going to be taxed at whatever $280,000 range is, anything above that. So you're going to be taxed at the highest possible rate, basically. That means that anything that you do to invest and get a return, you should be very, very conscious of your tax. And there's two ways to be aware of it. Number one is what legal structure owns your investments. Maybe you might be better off creating a family trust or using an investment bond or correct, like if you've got some other legal structure or your partner's name or something like that, those are the things that I would be looking at. And the second thing is the actual investments themselves that you're making. Try to target investments that are tax effective. That doesn't mean go for the thing that's most tax effective, because if you just go for the one that's tax effective, it's probably not that great of an investment, or you're getting really complicated stuff and it's just not worth going into. You still want a good return. Like my old cliche is you'd rather share a profit with the ATO than a loss, than take 100% of that loss. But that said, the third element, which is kind of like an outlier in Australian society, is negative gearing. So a lot of people with negative gearing do it for the tax benefits as well as the long-term growth potential. Now, there's certain tax consequences with that, so it'd be really good for you to speak with your accountant. The final bit of education I'll pop in here for people is that, just generally speaking, you can go to an accountant for tax deductions, for setting up things like I mentioned, a trust or whatever. But there is a particular class of financial advisor in Australia, which I think you're one of, Jem. And I have recently done the qualifications for it. And effectively, they're called tax financial advisors. So these are people that kind of sit in between a tax accountant and a regular financial advisor. And I don't want to take away from anything an accountant does because they normally work together. But in this instance, some financial advisors can help you tax plan, can help you optimize your tax for investing, and so many other things. So seeing a financial advisor may actually be really fruitful in this regard, because if you can structure your investments, make the right investments, you're probably going to save back on their fee what you can get back in reduced tax in the first 1 year, maybe even 2. So might even be worth paying for that. But it's a really good thing. We're all going to pay taxes. With the supercomputer at the ATO, it's getting more and more connected. We've got an ATO episode coming up soon. You'll hear all about how the ATO makes it, quote unquote, easy for you to file the right tax return, but also for them to make sure you're filing the right tax return. So keep an ear out for that. The next question, we've only got 2 to go. The next question comes from 59 and a half. This is a really good question about retirement, Jim, and it relates to super, which you've got so much experience in. My question is about ceasing an employment arrangement after the age of 60 to have full access to your super at that point in time, but then continuing to work in a different job. Is this subjective? Can anyone do this? And if so, why would this be a strategy as opposed to another option? Like a 15% difference on the tax on super earnings for 5 years would be substantial in most cases for those who wish to keep working. Now, what we need to do for people that aren't even thinking about retirement is let's just start at, the very basics, Jem. Mm-hmm. How is super taxed? Like they've said 15%. Yep. What does that mean?
Yeah. So what this person is talking about is, while most of us are working, we have what's called accumulation super, and it's like a big bucket where money's going in from work, we can add money in, and it's growing with investment returns. Now, those returns, how that grows is being taxed at 15% or up to 15% internally by the super fund. When you're retired, when you've met preservation, you can actually move your super from accumulation, that bucket, into what's called a pension or an income stream. Think of it just putting a tap on the bucket that now money comes out of it. And that actually has a 0% tax rate on all the earnings. So you could be invested exactly the same, getting the same return. One of them 15% tax is coming out, one of them 0 is. So what this person is talking about is preservation is when we can access our super. Now, for most of us, that is 60. If we stop working from 60 onwards, we can access it. If we're still working continuously, the next goalpost or milestone is 65. At 65, you can access it regardless if you're working or not. But what happens is at 60, from 60, so just think between 60 and 65, if you leave an employment arrangement, so you stop one job and you were to retire or to go somewhere else, maybe you started your own business or you left your regular job pretty much and went and did something else, started a new job, think of it the easiest, you then have met preservation on that superannuation that you've already built. So you can withdraw it tax-free, put it into one of those pensions and get tax-free returns and income. And it's just as if you've kind of retired with that money. So so that's how that works. And then if you go back and you start working elsewhere or work again in the future or whatever, more super potentially will build up. You might have a pension then in that case that you've already moved, and then you will have it will start again building up another accumulation fund. And that one will be preserved. So think of that as locked away until you meet that condition again, like leaving, hitting 65, starting a new job. So this person's pretty much saying, why doesn't everybody do this? Why don't we all get to 60 and do that so that we can get these pensions and move into pension and get 0% tax? And yeah, it is absolutely a strategy. So they're saying, why isn't it a strategy, not just an option? It totally is. So a lot of financial advisors will talk to people about that because it works with a lot of people's plans anyway, but it also doesn't work for a lot of plans. Like if you have a very stable job, lots of sick leave, lots of annual leave, all of these different benefits and things, it might actually be really tricky for you to, like, there might not be enough benefit in you leaving that occupation. Also, getting a job can be really hard, especially at that age. So it's not actually as easy for everybody to do that, right? But yeah, if it was, I think we would see a lot more people doing it. But I honestly don't think it is as easy as we probably make it sound.
So in the previous question, we talked about tax structures, right? And for anyone that's younger, one of the benefits of having your money in super is that at the moment it's taxed at 15%. Now, obviously, there's been a lot of change in the government's promises and what they expect to deliver through Parliament. And over the next 30 years, I can guarantee you there's going to be so many more changes that come for super. But as it stands right now, you can be taxed at your own rate, which the previous questioner was taxed a lot. Or you can put money into a super that's building for you, the accumulation one Jen was talking about. It's 15% tax, which is still lower than most people's income tax rate, so it makes sense. But then once you flick that tap on, it goes to 0%, which is really effective for a lot of people. And the reason is that the government wants people in retirement who are genuinely needing that money to live on, for that to last throughout their life. That the government doesn't want to have to see you run out of money so that in 4 or 5 years or 10 or 20 years, they're going to have to then start paying you the age pension or something like that. So this is a really good initiative. It's a really good thing. And it's one of the many reasons that we say to get financial advice leading up into retirement. Not when you've already retired, but like leading up into retirement. It's a really good way to do it. A really good time to do it. Sorry. So many strategies available. And you can, it's not just like a lot of people think, well, I'll just do that thing then. Why do I need to see a financial advisor? It's because there might be that one plus 10 others that you could do. And the order in which you do them is what's important.
Is very important.
The actual steps that you need to take are confusing and you might get it wrong. So that's why it just makes sense. And once you get to that amount of money, it obviously makes more sense because you can afford the cost of financial advice. So the final question comes from Goldie, which is a pretty apt name given the nature of the question. I've been considering adding gold to my portfolio, but I don't know where to begin. How do you even buy gold? This is a great question. Did you want to take a run at it first?
This is a question that I have asked myself. How do you actually buy gold? Because I've heard clients tell me that they have gold bars like in their house, or they've got it in a safe deposit box, or they have it in like a storage facility type place, like that a safety deposit box thing. Yeah. So I'm always very interested in, because I don't have any of these type of assets. But yeah, so there's lots of different ways that you can have the physical gold bars, coins, and that might be that you've purchased them or they have been passed down in your family or something like that. You can absolutely have ETFs and funds that have them. And then I did a quick Google, and then they were saying that you can buy digital gold. And
so digital gold's pretty common nowadays. So
yeah, what's that?
Yeah, so if there's something that could be invested in finance, someone will figure out a way for you to go and do that thing. And it's depending on how you do it, it's either safe or it's not. Let's start with the easiest way to invest in gold, which is through an ETF. So the big ETFs in the country are the GOLD ETF from Global X, sponsor of our Investors podcast. QAU from BetaShares, which is a sponsor of this podcast. And then another big one is actually PM Gold, which stands for Perth Mint Gold ETF. Now, what's interesting about these three ETFs, we don't own any of those, by the way. In the Rask Invest portfolios, we own 2 other gold ETFs, but not one of those 3. What's interesting about these 3 gold ETFs is this is a bit of a story, but it will actually help you understand how it works. So when the GOLD ETF, which is the Global X one, started, that was, I think, the first one in Australia, maybe even one of the first in the world. I know the founder of Global X was the first one to ever do it globally. What actually takes place is when you put your money in your brokerage account, you click buy on that ETF. Over in London, there's a big vault of gold. I think it's at Lloyd's Bank. So not to give away where the money is, but it's at Lloyd's. So if you can get in there, there might be a fair bit of gold for you. Basically what happens is there's a big vault in London. And Global X, as an ETF provider, would have effectively a pile of gold. If anyone's seen the movie Die Hard, where they break into the reserve in New York City and they're stealing all the gold from the vaults, and there's like different piles in like different little rooms. Think about it like this. Whenever you purchase some gold, behind the scenes, what happens in London is some gold moves from someone's pile into your pile as the ETF. So the ETF's got this big pile of gold in that vault. And that's effectively how it's settled behind the scenes. It's literally how it's settled. London is the world's largest kind of market for gold and commodities. That's why like a lot of companies like BHP and Rio Tinto originally had their shares on the London Stock Exchange. And so that whole marketplace is very well equipped. For the QAU ETF from BetaShares, it's the same process, except I believe the gold is actually handled in America through JP Morgan. I could be wrong about that, but I think it's stored in America. Really importantly, if you own one of these ETFs, you can go to the Global X or BetaShares website, click on the holdings, and it will have a daily updated spreadsheet. And you can actually see the bars of gold and the serial numbers that are on them. And that is just like a full kind of like, transparency thing. Now, I won't bore everyone with too much more details because the narrative kind of educates you enough to get to the point of understanding. But there's actually different types of gold ETFs in Australia. For example, the GOLD ETF that I mentioned is actually a company structure. It holds AGMs, even though it's an ETF, which is normally a trust. So there's a few different nuances behind the scenes, but in essence, that's what's happening. You would use a gold ETF because it's easier, it's faster, you don't need to store it, you don't need to pay for insurance, it's already insured by Lloyd's, all that sort of stuff, right? The final ETF, and this is how we bridge the gap to all the other things that you said, the PM Gold ETF. This is an incredibly unique gold ETF in Australia, Gem, and not many people listening will know this. This does not work in the same way. When you buy this ETF, what actually happens is the West Australian government guarantees a certain amount of gold for you. So it's not like there's a big gold bar that's just picked up and then dropped in a different pile for the ETF and a bit of that's yours. It's actually like a contract, right? But what's really interesting about this is you can go to Perth Mint and you can get your gold in gold.
Go pick it up.
Yeah, go pick it up. Yeah. So the whole concept is that there's actual gold there. And if you're worried about it, you're not even being able to get it, you can rest assured that the West Australian government, who's a very profitable government, I might say, thanks to the old mining sector, is effectively underwriting that. Now, if you're thinking, okay, I like this idea of owning gold, like the physical gold, but I don't want to go to Perth to collect it. That's okay. You can go down to literally any mint in your major city and you can go and buy gold. You can literally just go down and go, I've got how much money you got, $5,000, and I want to go, give me the equivalent amount of gold. And they might give you an ounce, which is the standard unit. That's like the little kind of, I don't know, it looks like a quarter of the size of an iPhone. And then they'll give you that. And then they'll be like, and you need a little bit more. So here's a couple little extra coins that balance out your amount of gold. The problem is then you got to store it. I've heard of people burying the gold in their backyard, really like just hiding it, having it safe at home. There's another company called ABC Bullion here in Australia, which is a company that you can literally just go to them and I think it's like $300 a year. You just buy as much gold as you want and they put it in a safety deposit box for you. Straight out of a Jason Bourne movie. You'll have your own safety deposit box. There's a fee associated with it, but you can hold on to the gold. Now, for me and my part, if you're going to invest in gold, ETFs are the way to go. It's so much easier. If you're into it, cool, do it. For what it's worth, you can do the same with other commodities like copper. But if you had $5,000 of copper, you would probably need a wheelbarrow to move it around. So that's how it all works. And hopefully that makes sense and illustrates how interesting ETFs can be and how they actually work. If you just replace the gold in the vault for shares on the stock exchange, it's exactly the same concept for a share ETF or for a bond ETF. It's exactly the same thing. So the only difference is you can easily visualize gold moving in a vault. You can't always visualize shares changing hands rapidly behind the scenes for your NDQ ETF or something like that. Does that make sense, Jim?
Yeah, absolutely. And I do get the attraction to like the physical asset because people like it like they do property, like that bricks and mortar that they can see, touch. Yeah, no, I totally get it. And it does have a place in people's portfolios like anything. It's about diversification. And it might be part of your core, your like a core satellite strategy. You might have some of it in your satellite, a small allocation. But yeah, the main thing that worries me is when people have it at their house. It's like when people have lots of cash or whatever at their house in a safe, or it makes me very nervous.
Yeah. When I was growing up, my grandparents on one side are Holocaust survivors. So my mum's an old Polish wog, and my grandma's an older Polish wog, and she would bury the money in jars in the backyard. And so when we were kids, we would go around the veggie patch and just like dig in the dirt and stuff, and we would just try and find all these jars that she had lying around. And I don't know who bought that house after us, but now that she's passed on, but I'd imagine there's some, if they ever do some renovations or do some earthworks there, I'm sure they'll dig either some gold, some silver, or maybe some old banknotes out of the ground in those jars. So you'll have to do some research if you're listening to this to go and find out where my grandmother lived. But yeah, it does make me nervous. Like, it also makes me nervous talking about gold generally speaking, because people sometimes take it to extremes. In our portfolios, the maximum amount that we have is 5%. So just for people's awareness of what we're not saying that's right for everyone, but just in general, that's for some of our strategies, definitely not all of them. Well, Jem, this has been fun. So we've had Sheila Frugalism writing about the First Home Super Saver Scheme. We are doing a webinar this week on the Rask YouTube channel. If you're buying a house, seriously, come and check it out. Ask us your questions. Albo Coffin Feeder asked about paying too much tax. There are different structures. There are different investments you should definitely be looking at. Speak to your accountant, speak to your tax advisor. 59.5 said about, doesn't everyone think that this is just awesome to be able to switch your super into pension mode? Yeah, it's pretty cool. Definitely read up about it. Speak to an advisor if you're a bit worried, but it's definitely a strategy, and it's good to know. Jem gave us a rundown on how tax works in super. Finally, Goldie, adding gold to your portfolio. It is easier than you probably think. You can start with just a few bucks in one of those ETFs on a low-cost platform. So plenty of options for you. We also got an update on the Viennetta ice cream, which I think I'm going to go try now, Jem. I've after I'm done at Dog on the Tucker Box, on our Tucker Box, I'll go there. But I hope you enjoy your time in Sydney. Sorry about the Maroons. I'm sure they'll come good again. And as always, thanks for joining me.
Great to see you, and I'll see you next week.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.